Welcome to the Core 4 Show. I'm Coach Brandon. And what's interesting about this week is that when I first started this show, I was one age, and yesterday I turned another. So one more year around the sun. It's a new year for me. Everybody thinks January 1st is a new year, but in my world, my birthday starts my new year. So hopefully for all of you guys have had a great week, a great 2 weeks, because we were off the week before. And thank you very much for being patient. All the well wishes that I got from all of you guys are greatly appreciated. But I want to talk a little bit about Core 4, and it's going to be a new year, right? So I'm telling everybody to understand that in this journey that we call life, there are going to be things that we are up to, that we are going after, and basically that we're utilizing. And these tools that we're bringing into our world so that our journey becomes even more unique and defined is built around our resources. What resources do we have? What are we exposed to? So Core 4 has 4 elements. It has mindset. It has 9 to 5 thinking. It has investment strategies. And of course, finally, it has retirement. And so our journey in Core 4 and the team that we have here is just to share what we're up to. We're not financial advisors, but we're just a group of concerned community citizens that are basically out here trying to make a difference in this world for ourselves and our families. And so by doing so, our extended family is this community and anybody that wants to get involved and learn what we do. And so with that being said, our mindset is, how do we think? How do we view the world? 9 to 5, how do we replace our 9 to 5 income and not think like a 9 to 5 individual? We've all been reared for that. Oh, you go to school, you go to college, you get a good job, you work that job for X amount of years, and then you look for retirement, whatever is in between. But at the end of the day, it's a typical 9 to 5 where you exchange your time for dollars. And so nothing is wrong with that. And that has helped our economy. But there's ways that we can then say, let's look at investments. And we have active and we have passive investments. And what do those active and passive investments mean? What that means is that we can generate more money after we've made money with our capital. We are made money with our time or whatever it might be. And then we use that money to make more money. And so I call an active or a passive investor basically being like an employee that we have charged with some task to be able to generate income that we control. And then finally, we would have our retirement. What kind of things are we putting our money in where we can just kind of think about it like it's hibernating? And when it comes out, it's fresh, it's ready. And during the time that we're not as active anymore, we don't have the ability to be as astute to how we make money or how we make our daily income work, then our retirement is able to kick in, and it's something that will hopefully be significant, that will make the lives of the others around us not feel that they are involved in our financial endeavors. So that's kind of what Core 4 is all about. And so one of our main things, and we have different ones, and we'll talk a little bit about those today, but one of our main things is that we have yield farming. And Eric Majors is a yield farming expert. He's one of our teammates. And so Eric has a course that he offers. And so that course has been very, very good. And he explains it in his course, how it works, what it does, all the manipulations. And he's even got some automation to it. So we're going to bring Eric on for about 2 to 3 minutes. And we're just going to talk a little bit about what yield farming really has been doing and how we can get involved. Eric, how are you doing back there?
I'm doing pretty good. I want to share a screen with you guys real quick here. If we can do that.
Let's do it.
Share screen. If I can get the right one here. Okay. Yeah. So guys, can you see that on there?
Yes.
So I have a course on yield farming, right? And I'm an expert in this. So we have a hedge fund we're starting and all this sort of thing. But what I want to do is bring something down to just for ordinary people, the woman who needs maybe an extra $100 a month, or, you buy groceries or a week or something like that, or all the way up to the guy who's got, several $1 million to trade with. And, most people are busy and they have things going on in their lives. And the best scenario for them would be that they could turn their money over to somewhere where it could work for them while they're sleeping 24/7. And I'm showing you a chart right here of Ethereum versus USDT. And I'm just going to share with you guys real quick that this method of earning, I'm going to call it at this point passive income, because I have an automation I'm just going to quickly run through to show you guys. It's coming out of my course, but I've created a course in a nutshell that enables anybody, without whether you have any experience in crypto or not, within 5 hours to get into an area of crypto where you can earn fees off of everybody else's trading. Okay. And I'm throwing this chart up here to you guys to look at an Ethereum coin because it's zigzagging all over the place, right? The beauty of this is that I don't have to really pay attention to any of this. And I just want to give you a quick example here. There's a new automation tool that I'm putting into my class this week that literally on August the 14th, right, just 4 days ago at 9:47 p.m., this is what my wallet looked like right here. And what I want you to look at is this USDC here, $108, right? Now, I have done nothing this weekend except go to the beach, do chores around the house, go shopping with my kids and whatever. And today, in my wallet, I wake up and there's $865 in there. I've done nothing. I haven't looked at this since I deposited the money in there. And that's 4.5% for me doing no work. I'm just living my life out here other than just knowing how to do this. So this automation tool is an example of what can be done in yield farming. And I'm here to tell you anybody can do this, and this is what we have on offer. And I just wanted to share that with you because I don't know about y'all, but I think that's incredibly exciting. I mean, this is how I make my living. I don't really do much of anything other than this.
That's more than exciting.
Yeah.
More than exciting. And so when it comes to the automation, do you see, well, look, it's all transactional based, right? So that 4% that you're doing this week, you pretty much, no matter if it goes up or it goes down, it doesn't
Yeah.
matter if it's going to be transactions, and you're capturing that.
Mhm.
And with the automation tool, it puts it so that, if you got $1,000, you're making $40 a week. If you got $10,000, you're making $400 a week.
Yeah.
Is
Yeah.
that?
That's 100% true. And I'm telling you, this game is getting easier every day. It's getting so easy that I don't know what they're going to do. Once people really see that what's happening over here, they're going to pull all their money out of the different markets, and then we're going to have to deal with regulators. It's just easy. Okay, so get in while you can, make the money while you can. I just, so few people know about how this works that it's sure to stick around for another 4 years, I think, of runway. But the bottom line is every day it's getting easier. And in my course and the community that I have, we are able to uncover the tools quickly because I work with so many different people that can quickly throw up these automation tools as they come out. And these automation tools are just making something that I think was already easy even more easy, to the point where you don't have to do anything. You just wake up and money's in your wallet every day. Off the buying and selling of other people. Right,
Well,
off their trading.
Well, one of the big things is most people really want to be passive investors and not active. And one of the hybrids of the course originally was that there was some work that you have to do, but now it's a set.
No work.
Now there's no work. Well, look, it's a beautiful thing. It's a beautiful day, and I am so excited that we're going to be starting this week and getting our community involved. So, thank you. Let's go. Let's do more of it.
All right. God bless you. Have a good one, guys.
See you later. All right, you guys, that's crazy. So we're going to bring Eric on typically at the beginning of the show because Chris, James, and I, we're talking through, and we may have some other guests. So I want to make sure that, like, some of the regular stuff that we're offering, that you guys can see that at the very beginning. And so being able to see that from Eric, and then I'm going to be doing something similar so you guys can see the account that I have working and growing. And again, this is about the journey. So you're following the Core 4 journey, you're following Eric Major's journey, and it's a beautiful one. So now let's jump in and dive into kind of what else we offer. So we offer the Kong bot, which has been fantastic. We offer Go Baby Trade, which has been fantastic. And these are just tools or employees that we've talked about before that have been making money for us. And so what I want you guys to do is just to know that if you want to see it, if you want more information, just email me. Some of you guys already have my number, and let's take it to another level. The goal is to educate ourselves and participate. We also have a case study that we're doing together for some of you guys that are involved in that case study. And that case study is reflecting on cash flow NFT, Miracle Cash, and more. And so all of this crypto stuff is very interesting, but the idea is that we don't want to get scammed. We want to protect our money. We want to protect our assets. And the way to do that is to create this community where we share and we grow together. So without further ado, I want to bring on Chris. What's up, buddy?
What's up, Brandon? Happy Sunday.
Man, happy Sunday to you too, man. So I'm sorry you missed my birthday party. I realize.
I am too. If it was just next door, I would have been there, dude. But
All right, well, let's
it's been a
plan
busy
for next year. Let's plan for next year. We're going to bring James on too. James,
how's it going, brother?
Man, you got 50 on there. You need to have 54 on there. I'm 54, baby.
Nice. Well, congrats on making it, and here's the many more, my friend.
Thank you, brother. Thank you. So, look, we said we were going to create like a dialogue here and really talk about how our community can get to the next level. Chris, you ready to share your screen?
Yep, it should be there. Yep, perfect.
Here we go.
Cool. So it's been a couple weeks since we had the Core 4 show. We were getting pretty bearish. My analysis was pretty bearish going into the middle part of July, which turned out to be pretty on point. This little drop that we saw in the market, it would have been August 5th was the low here. This is the S&P futures feed, which was actually very tradable because this is a Thursday, Friday, and a Sunday night open. Brandon, we did Core 4 that Sunday night when things got a little crazy and the market opened up. Was really disruptive. I'll just put it in context of what we've seen the last 34 years. Basically, the volatility index, the VIX, has been around since 1990. It's only spiked up above 50 3 times. And that was the Great Financial Crisis in 2008, and that was COVID in 2020. And we did it again just on that day, the 5th of August. And so what's interesting is when the volatility index has been that high, it's basically been with just a pure bear market to go with it, and that was not the case. So what it truly was is a volatility event. It was really disruptive, but you can see here that the market has responded in a very, very big way that just continues to reward the culture of buying the dip for right now. And the nice thing is that there was calls for the Fed to have an emergency rate cut that Monday because things were so bad. Just to put it in context, we were about 10% off the highs in the S&P, just over 15% off the highs in the NASDAQ. The NQ feed, the futures feed for the NASDAQ, did reach just shy of 20%. But here we are bouncing back, and we pulled back about 78%. Now, for the remainder of the month, we don't really have a ton of U.S. data, but we've got enough. Earnings-wise this week, we have some consumer retail stores, so Target, Macy's, big ones this week. We've got some China ones with Baidu. I'm looking at some other ones here. BJ Wholesale Club. We got some auto parts. We have Toll Brothers for housing. So it's a little thin, though. I mean, 108 stocks this week. Earnings season is pretty much a wrap. Mag 7 didn't save it. In fact, Mag 7 earnings came out and it wasn't enough. But what flipped this was, the market for a moment thought that, oh my gosh, the Fed is now going to cut, and they're going to cut while we're going to have inflation, have a recession because we're missing in like employment numbers are so bad now. And let me just give a quick example, and feel free to jump in here. I know I'm talking fast, but a couple of things that I've been paying attention to. If you look at the labor market, and I'd like to get James's feedback on this too. I mean, I'm just going to share data, talk about trends. This is our labor market with the non-farm payroll that comes out every Friday, or once the first week of the trading week on the month. So the first Friday of every month, we have non-farm, we have average earnings, non-farm, and unemployment rate. Now, on August 2nd, the unemployment rate came out higher than expected. This activated what was known as the SAM rule, which is SAHM. All that means is that the 3-month trend in unemployment is higher than the lowest 12-month look back. And so it was 4.3%. So you can see here that the trend is higher. Let me use a different color here. So the trend on our unemployment is higher, okay? And then you look at our job numbers with non-farm payroll, and to me, this looks like our trend in job numbers is lower. And then we take that with our wage growth. Wage growth is trending lower. You look at job openings trending lower. So I think the data isn't that supportive of I'm not saying that we're in a recession, but we're certainly trending in a way that our jobs and employment numbers better improve, or else the Fed will be cutting even by 25 basis points, but cutting on the cusp of a recession. You go into the AAI sentiment survey. That is a measurement of investors, bullishness versus bearishness. When we had that drop on August 5th, the market dumped about 22% in bullish sentiment that day. So it did kind of neutralize things, which I think is a good thing. Like I said, the reward has been there for buying the dip. What I think I'm a little exhausted on is just the fact that if you look back since 2018, which I look way further back than that, but since 2018, we have seen mostly booms and busts. 2018 to start out the year was a terrible 20+% decline, ripped up to all-time highs in 2019, crashed during COVID in 2020, ripped up to all-time highs during 2020, 2021, crashed in 2022. Here we are just ripping through all-time highs again in 2024. James, I know, has a year that's in mind, 2026. I wouldn't be surprised if 2025 gets a little rough probably halfway through the year. I don't think this cycle is going to stop. I think this market, the sectors rotate faster, the cycles happen and end faster. And so we might just be on our way to like another blow off top, a capitulation move, and then that ends really poorly. Or we look to see if the market's going to go sideways for the first time since 2015.
So I'll jump in with what you just said there. So I do agree with you. I think second half of 2025 is kind of, we'll probably have one of those years that we've had, I don't know, for 5, 6, 7 years in a row there for a while, where it was just like the market grew 0.9% for the year. It was just basically dead flat all year in 2025. And then looking at 2026, looking for a pullback. But I do think we are. So again, I said this 2 core 4 shows ago, is that I think we'll have a Main Street recession, but a Wall Street boom at the same time. And I really do believe that. So interestingly enough, when you doing research into non-farm payroll. So first, I think it's funny. It's odd how we put so much credence into it, because, it's just a survey of 60,000 people.
Yeah, it's also mostly government jobs too. So,
yeah, it's mostly government jobs. Well, what's interesting is that some recent data that just came out. I talked about this weekend in an economics class, but employers are closing job postings.
Right.
And the other thing is they would create like 7 job openings for one position. So it looked like the JOLTS jobs numbers was massive comparatively to what it should be. So I think we're going to see that tighten up and continue to tighten. And we're probably somewhere in the 7 to probably the 7, high 6s, low 7s for actual jobs. Then the other part of it is look, I believe that your job is not going to be replaced by AI, but you're going to be replaced by somebody who knows how to use AI.
For sure.
And that's what I truly, truly believe. And so we're seeing that happen, and just people becoming more efficient, businesses becoming more efficient. And when you raise interest rates to the point where they were, and you have companies that take variable rate interest loans on debt, and then they have to take out more debt to finance their companies because sales numbers aren't great. And then they take out debt to invest into expenditures and have CapEx and things like that. You get this debt cycle where you have these high interest rates. Eventually they do need to cut, but it's going to take about a year before it settles into, companies, and the companies start to expand again. And so you figure they cut probably September. I think it's almost like a guaranteed kind of 0.25%. Maybe November, I'm seeing information as well. Another cut in September, and you look at November, a probabilistic another cut there. And then, December, I don't know if we see that rate cut in December, but maybe. But I do think that,
this is 25 and this is 50 basis points. So December, I think December has to change into another 25 basis points. And again, we talked about this in the show. I mean, if the Fed is cutting while a recession is happening or imminent, the average S&P return is negative 15%. If the Fed is cutting while we're still in even the last couple of innings, this eighth inning, this ninth inning, maybe it's overtime, it's extra innings. But if there's anything that's left in this expansion, the average S&P return is around 10% positive. So as long as the Fed and the economy is not necessarily tilting into an imminent recession, the market's going to be fine. And to James's point, yeah, I think Main Street feels it, Wall Street doesn't. And it looks like that disconnect once again of the haves and the have-nots. But I could see Wall Street just buying the dip. There's still money that has to circulate in. You've got you've got household wealth that is at the highest of all time. You've got housing affordability that's the worst of all time. But the reality is, people are still going to be okay to like survive. And so I do think the consumer cuts back a little bit, but they probably still travel. They probably just cut back on home
actually,
projects.
I want to chime in here with something, Chris. So this is an unbelievable statistic. I just finished a lit review, and I use this stat in my lit review. I'm bringing it up. Give me 1 second here.
Okay. You're bringing it up on the screen to show?
No, it's just something that I've written out. Okay. So in 2014, the top 10% of net worth in the United States had about $54 trillion. And the bottom 90% had about $52 trillion. In 2024, that number is over $101 trillion to the top 10%.
Yeah.
And the bottom 90 is still 50.06.
If you James, how do you track the top 10% consumer? Because that's another thing I want to track. If I can track the top 10%, if that top 10% starts to scale back, that's when consumerism and our economy as a 70% GDP consumer nation, that's when we start to feel the cracks.
Well, that's the other thing is most consumption happens from the bottom 90, not the top 10.
That's true.
And the interesting thing is that the top 10% have access to invested markets. And that's why you see why we talk about the Main Street pullback and the Wall Street boom, because they're going to be investing in businesses and investing in companies and investing in opportunities like this. So where it's going to be felt is just widens that gap. The top 1% has, I think it's $46 trillion. Is what it is. The top 1% nearly has as much as the bottom 90%, which is crazy when you think about it.
Well, it's happened since 2000. I mean, dude, since 2000 to 2008 to 2020, you look at every bust that we've had, every recession we've had, every massive drop in the market. It's always going to the top. It's always going to the top of the food chain.
So let's talk about this. Because I'm in that 99 percentile, right? So I'm not in the 1% of the rich. So how do we take advantage of that so that we can start growing our capital and making some dents? And, just like in basketball, they talk about parity. Let's get some parity here. What do you guys think? How do we do that?
Yeah, well, I mean, right now, households, it's about 63% of the country has invested assets. So, I mean, if anywhere there's a place to start, in my opinion, it would be you can fix your household budget, which means spend less on where you live, spend less on what you drive. Those are the two biggest fixed expenses for most people. On top of that, whatever you can save, whatever you can invest, do it, because time in the market is a lot more important than timing the market. Because look, man, I don't know if this market's going to go up. And I talked to James quite a bit about this last week. I mean, I have really simple trades that 1 or 2 weeks out make money with a high probability, and I don't have to pick a direction. If that's all I did for the next 5 or 10 years, whether the market goes up or down, if I can pull out an extra, 1-2% a week, 1 or 2% a month, and do it with not having to pick market direction, great, I'll do it, because I've got the buying power to, if I have a break even week on one contract, then I have a winning week on one contract, then I lose on one contract, the next week you get on 2 contracts, I can do that for 5 to 10 trades in a row and still break even or make profits. So I think the first thing, in my opinion, is balance the budget on the home, right? So where you live, what you drive, and then just get invested. I mean, I've said this for the last 5 years. There's no better time to be a trader than now. There's no better time to learn how to be a trader than now. It doesn't have to be that hard. I mean, look at the market does. The market doesn't care if we're in a recession, doesn't care who's president, doesn't care if we're in a war, doesn't care if we're in inflation, deflation, high risk, low risk. Market doesn't care. I mean, if you just stay in the market, time in the market, tends to pay pretty darn well.
2 things I really think. There was a paper that I cited from 1998 that said the very simple fact of the reason why people don't retire when they want to or with as much money as they want to is that they just fail to save or they fail to save enough. And you have to think of, the concept of you have two choices really is either A, you learn how to trade on your own and you go through and you go, through education and learn and get the bumps and the bruises that everybody takes who learns how to trade. I've never met a trader who's had 100% winning record their entire career. Haven't met one yet. I know maybe there's somebody out there. Or you do something like making your retirement and making your investments a bill, right? You don't earmark it as a bill. Just like you got to pay your electric bill, got to pay your car note, got to pay your mortgage, pay your brokerage, right? Make that a bill. Or you can do it through, one of the things I use, and this is why I think one of the tools I use is a great tool. It's a fixed equity indexed in universal life policy. And it is a bill, and you can adjust the payment that you pay into that bill, but it has a guarantee of no loss and a guarantee investment aspect, and you're going to be exposed to the market with that. And it just, regardless of what happens, you have to make it a bill. It's a mindset shift, is what I think. And
that's right.
YouTube has leveled the playing field for education, but there's people like mentors and stuff that, education, that what you're doing here with Core 4 is part of it, is creating a platform where people can come to learn and can come to find out what education companies are good and what's crap. Chris, real quick, I'm sorry, Brandon, my ADHD is coming out real quick. So I'm looking at this chart and I'm seeing left tip, center tip, right tip, King's Crown. We broke that
of course,
level
dude.
of support back in June.
But this isn't Forex, bro. Like that's
True.
The thing is this isn't Forex, and this low hasn't been breached. So I see this, I see this equal level. I could see the market doing absolutely this right here. High, low, lower, high, lower, low. Come back and retest and get those bulls to get baited in here and then fade this move over the next week or so. Now, here's the question. Are we going to see a fresh low or are we going to see a fresh high? And I truly don't know. I would say that there is enough reason to believe that the top is in. But based on this, if we were have the same conversation, James, and we're sitting here at the 50% zone, I would be much more in the camp of we're going to retest the low. But the fact we came up here to the 786 pullback zone, and it's like I could see the market trying to just work its way up here, trap the heck out of this, be a broadening pattern that confuses everybody because this is going to be the ultimate bull trap. And then we drop back to the midpoint or we drop worse. So like I said, I don't know and I don't care because I'm going to find a way to navigate this and make some profit. But dude, I hear you, but the stock market is not Forex, dude. And so unfortunately it's just a V bottom happens.
The only reason why
this is a V bottom right there.
The only reason why I see that technical fulfilling is, when that Sunday, what was announced that Sunday that caused that Monday to be so crazy and wild was Berkshire Hathaway, Warren
dumping
Buffett
Apple shares,
sold 50% of his Apple, and then Nvidia announces a 3-month delay on theirs. The two biggest, and then Amazon
and the Japanese yen dumped 27%. And 17% in 2 days. That didn't help.
Yeah, exactly. And then Amazon misses earnings. All three of those things conflated to create that instant return. And you see how we've been preaching it. You and I have been talking about it in the show all the time.
We were spot on with the correction. We really were.
It's
we were
we're
spot on.
So concentrated on these few little stocks that if any one of them or 2 or 3 of them fall,
that's
boom. And that's exactly what we saw in that heat map. And we're seeing this happen, and Nvidia is just on the cusp. They're 3 months delayed. But what happens if the redesign, or what happens if there's a delay, or what happens if there's some other geopolitical event that slows up their thing?
Look, anything that gets nasty in China is going to hurt Nvidia, which is going to hurt the entire stock market. Nvidia, the one thing. So here's what we do have till the end of the month. We have Jackson Hole this week on Thursday, Friday, Saturday. We have Core PCE at the end of the month. We have this Friday with Jackson Hole. We also have Powell speaking on Friday. I want to say we have U.S. GDP numbers. We have PMI on Thursday. So there's a little bit of U.S. data. But
GDP
the end of the month,
Thursday.
GDP Thursday, FOMC minutes on Wednesday, Jackson Hole Thursday, Friday, Powell speaking Friday. And then at the end of the month, the 28th, I believe, is NVIDIA earnings to kind of wrap up the month of August. Now, one thing I also have in this chart here is the seasonality. If I go month to month, historically speaking, September, October are two terrible months in the stock market history. So you're looking at the 5 and 10-year average in addition to what we've seen historically. It's called the September effect for a reason. A lot of times markets come out of summer and they sag and there's tax loss harvesting. People are concentrating the portfolio to clean up the crap and wash away, good and bad, just trying to get ready for a Q4 rally. But I don't see the market ripping the way it just did the last couple of weeks and still doing it through September, October. And I said this earlier, and I will say this again. If we have a rough Q4 where this stock market is not making all-time highs by Q4, I'm way more bearish going into 2025. So I think there's good volatility ahead. To James's point on the technicals here, realistically, we've had 1, 2, 3, 4, 5, 6, 7, depending on what today's candle is. This could be 8 candles in the futures market. If we go to the SPY, I know my chart's a little bit messier here, but 1, 2, 3, 4, 5, 6, 7, 8 out of 10 candles to the upside, coming back 78%. What I'd personally like to see is this is where the market likes to stall. We pull back at some gaps. We either justify and stay here for some sideways movement, or we just get more volatile, man. I mean, I could see this market playing around with some volatility, maybe coming in here and fill a gap and maybe give us another, 15 to 20 point move on the SPY. But I would be really surprised if we just keep going up here. And if we do, I'm looking for a top in the short term. I think that would be absolutely crazy to see the market take out the highs and then within 4 to 6 months, take out the lows. That is going to drive investors crazy. And it's going to be like, where's the risk off? Like, where's the door? And that's what also happened on that Monday sell-off on the 5th was there's one exit when it comes to a deleveraging event and everybody's going for the same door. And it's a fire hazard, So that's why it was so gross and so awful. And I don't think anybody really knew it. I mean, if you're in the markets, you knew what the hell was going on. But if you were not paying attention, it doesn't really matter because we're only, single digits off the highs. So who cares? But for a lot of traders I know out there that had leverage and they're trading, options or futures, Forex for that matter, there's a flash crash in the Forex market we haven't seen since 2020. So there's a lot of disruptive stuff out there.
What was that? The other thing is I keep saying is if you have a gold chart to bring up, that would be sure. Yeah, if you look, it's at new highs,
man. Yep.
2540.7, I think it is.
2504. That's a healthy daily candle from Friday too, by the way.
Yep.
So gold's looking good.
Yeah,
Silver
on
as well.
COMEX, GCW00 is 2541.10 right now. I'm looking at that. And you're seeing like massive gold, spike in gold right now in the value. So that means people are running to a safe haven.
They're trying.
Yeah.
Yep. Yeah, for sure. Brandon, sorry, we don't need to cut you off. We're just, you let James and I talk all day. We're going to.
Yeah, I know, but it's fascinating to hear you guys. I think one of the big deals is, how does the regular person capitalize on all this? When they hear all these possibilities and stuff, and obviously we're not giving financial advice, but
look, can I say something here? Just really easy and just I'm going to throw it out there for anybody watching. Okay, we have Mag 7 for a reason, right? Which is the largest tech companies in the world, healthiest balance sheets. There's been more stock buybacks from Apple than like 490 companies in the market cap of the entire S&P 500. They have more. I would rather buy a corporate bond from Apple than I would the U.S. Treasury. That's how confident I am that Apple will not fail compared to our government with a balance sheet now that has $35 trillion in debt. A fiscal cliff is going to be something the U.S. has to face. I don't know when. I know there's creative accounting, all sorts of crazy stuff that can happen, but we are going to have a fiscal crisis at some point because we can't keep adding $1 trillion to our deficit every 100 days. It's insane. But I've told this to family. I've told this to friends. If I have friends of mine that are doing just their own passive investing, I just said, just like James said, it's a bill. I don't know what that bill is, but if you can afford to swing $50 a month or $100 a month, $50 in Amazon, $100 in Amazon, $50 in Apple, $100 in Apple, put it towards something that's going to have pretty consistent growth. I mean, Amazon to me at $177, we've got fair market value at $215 based on discounted cash flow and earnings. I also think that if you give Amazon another 5 or 10 years, it'll probably be $1,000 stock again before they split. Just like Apple was, just like Amazon was, just like Chipotle was, just like Nvidia was. All these companies that have good balance sheets with cash and growth, they get to $1,000 and then they split and they water down the shares. But you, as a stock owner, just get more shares. So I don't know. I just think if you want to do something really simple, it's starting somewhere. There's all sorts of proverbs and truisms like starting somewhere is better than not. I mean, there's no perfect timing, right? But if you just start and treat it like, okay, look, I can take $100 a month and put it towards this, you'd be surprised. I mean, I see my 401k, I see my rainy day funds, I see my whole life insurance, I see my policies that I have. It's like if you stash money away and it's growing at 6%, 8%, 10%, it looks good in 3 to 5 years. It looks good. It looks great in 10 years, but it's just starting somewhere, and it doesn't have to break the bank. Everyone can budget for investing. And like I said, only 63% are doing it. So if you're not in that 63%, look, if Warren Buffett's not a multi-billionaire because he got lucky. I mean, he's using one of the greatest vehicles ever to generate wealth. And it's almost unfair that our stock market is so advantageous to the wealthy, but it's there for everybody. And the gamification of trading, and everyone has a chance to do it. Now, I'm not a gambler. I think all the crap that happened with GameStop and meme stocks and all that shit, that's not what I do. But I'm talking about just being involved. I mean, there's so much opportunity here, but just don't chase meme stocks. That's ridiculous. That's so stupid. But good quality value companies, indexing is fine. Dollar cost average rebalancing, it's not that hard. It really isn't.
And I said this at the Core 4 event back December last year, right? The goal is to get rich right, not to get rich quick.
Yep.
Yeah.
Makes a big difference.
The big deal for all of us is, getting started. And I'll tell the community the way that you get started is listening to these two young men. They have a lot of wealth of knowledge. They have a lot of wealth of real interest in everyone's development. So, look, guys, thank you both. Let's do this again next week, as we always do. And let's start helping this community inch a little bit closer and a little bit closer to all of their financial goals and dreams by looking at us hit ours.
Sounds good.
Sounds good.
All right. Guys, listen, the Core 4 show is here for all of us to get from where we are to where we want to be. We have a creed that we tell all of our kids in basketball. We have a creed that I tell my own biological kids and that I live by. And that's number one, you want to become a subject matter expert. Number two, you want to be the best version of yourself. And then finally, number three, you want to surround yourself with people who inspire you. It's something that I do every day. And it's a joy for me to be a part of Core 4 and help others to realize their financial dreams too. So thank you, guys. I love you whether you like it or not. This is the Core 4 show, and I'll see you next week.